Hello, I'm Katrina M. Craft, and you've just tuned into the Craft More Cash podcast, where finance meets innovation and strategy becomes reality. With over 2 decades navigating the twists and turns of accounting, tax, and business strategy, I've had the incredible opportunity to work with startups and Fortune 500 companies alike, crafting pathways for businesses to grow and thrive. I've tailored my expertise to serve the unique needs of industries ranging from real estate to creators to marketing and beyond. I'm on a mission to equip individuals with the financial savvy they need to succeed. Through my Wealth Intelligence course, I'm all about breaking down complex concepts into actionable strategies for business owners. Welcome to Craft More Cash. Let's make wealth building simple, fun, and effective. Ready to transform your financial journey? Hello, this is Katrina Craft. I want to give you a disclaimer that this information is provided for informational purposes only. Please consult with your financial advisor or your particular professional accountant, because each information and strategy that I'm giving may not apply to you. In my business, we focus on business owners who are in the creative space, so they could be entertainment or digital creators, real estate investors, medical practice owners, and also consultants and coaches. That is who we focus on. So most of the information that we provide to those owners, we are very aware of what's ordinary and necessary in their industry. And that's why it's important to understand and work with someone that really knows your industry. Travel deductions. So ordinary and necessary business trips, hotel, airfare, 50% for meals and ground transportation. They are deductible. Your 2021 and 2022 tax returns, the deduction for 100% restaurant and meals were allowed. That was due to COVID, and a lot of restaurants were having problems with, getting revenue, having customers. The IRS allowed 100% deduction for business meals if they were at a restaurant in 2021, 2022. So if you have not completed those returns, make sure that you are reporting 100% if it was in a restaurant. So let's talk about travel deductions, renting from your family. Let's rent from your mom and dad when you travel. How do you rent from your family and they don't report any of the income? You need to make sure that they do not have in total more than 14 days of renting to outside people. Okay. That means that if your family is renting to you and then also renting to someone else, it cannot total over 14 days. Okay. So it doesn't have to be your mom and dad. It could be your siblings. It could be your friends. But what is important is you are making this a work trip. It needs to be that you're traveling to the location for a business reason and you have to travel overnight. So instead of staying at the Marriott, you're staying at the mom and dad hotel. You would have to pay the Marriott a fee for staying. It's the same when you're paying your family members. Let's say you travel to a convention, you rent your parents' guest room for 5 days and you pay them $1,000. Now it has to be a fair market rent. You can go on different sites to find out what a fair market rent would be to spend the night. That could be an Airbnb site, a VRBO site, where you see how much it would cost to rent a space, a room in that area for that same size and equal home. In this example, it was $1,000 for 5 days. So that was $200 a day. And it's business travel. The parents receive $1,000. That's tax-free income as long as they don't have more than 14 days of renting to anyone else throughout the year total. Sounds good, right? Let's see how we can make it work and look at the 3 rules that you have to follow. So we talked about rent for fewer than 14 days, so 15 days, so 14 days or less. The property has to be used total by whoever you're renting from. Charge a fair market rent. It has to be a fair market rent. We talked about that. And then we also talked about rent for fewer than 15 days to qualify. So 15 days for you, and then total, use the property as a home for more than 14 days a year. Okay. So you need to make sure that this is the personal resident. It's a resident for more than 14 days. So if they have a vacation house and they're only using the vacation house 2 days, and then they try to rent it to you for 15 days, that will not work, because they have to have this as a residence for 14 days for it to qualify to be eligible. So that's a great way to stay with your family, pay the rent. They don't have to record income, but you get a deduction. Now, I want to talk about purchasing fixed assets. The big expense here, there are different deductions that you can take. If you're purchasing things like vehicles, furniture, manufacturing equipment, heavy machinery, bonus depreciation is allowed. So in 2023, 80% deduction for these items. So that means immediately, now on the vehicles, it depends on the type of vehicle, so we'll talk about that. That means on the fixed asset, you have 80% deduction immediately. So if you buy something for $100,000, 80% deduction will be allowed as a bonus depreciation. So $80,000. In 2024, it goes down to 60, 2025, 40, and 2026, 20. There are some rules now. Well, they voted that maybe we will increase the percentage and will go back to 100% as it was in 2022. So they are currently in Congress talking about, should we increase it back to 100, because it really benefited the economy. So stay tuned for that to find out if it will revert back to the 100% as it was in 2022 and some other years prior to that. Otherwise, 2023, if you have not filed your taxes and you did have some property that you purchased, including the above, make sure that you took 80% bonus depreciation, and that's on your tax return. So in 2017 through 2022, that's when the bonus depreciation was 100%. And now we're thinking, hopefully they will revert that back to 100%, and business owners will be able to benefit from this bonus depreciation. So big tax break for qualified improvements to property. If you have a non-residential commercial property, so you are in storefront or office and you do some improvements, there are some big deductions for that. They are called qualified improvements to property. Make sure that if you are in that criteria, make sure that you are deducting these qualified improvement expenses. So what qualifies? It has to be non-residential. So if you have a rental property, we're not talking about that. This is a non-residential property and you're doing improvements. Congress really wants to encourage business owners to improve their properties. So starting in 2018, they established the category of depreciable real property, which is QIP. It has a shorter year, so it's 15 years. So instead of having to do a longer period of depreciation, they shorten it to 15 years. But for 2021 and 2022, it was 100% bonus depreciation. That's why we still need to look at the bonus depreciation tables to figure out if you will be allowed that 80% in 2023 or the 60% in 2024. Or if we revert back to 100, it could be even more impactful for you. If you are in a property that is like an office building, a restaurant, a bar, store, strip mall, motel, a hotel, warehouse, factory, then you could qualify for any improvements done to those types of properties. So this could be huge if you're doing renovations or improvement for any of these types of properties. You could have the deduction for QIP. Now, let's talk a little bit about, I think I'm going to open it up because I want to talk about the auto, but I also want to figure out, where do we go from here? So we have consultations, then we develop a customized plan, and then we implement. So on the craft money map is tax planning. Do you want to maximize the money you keep? Most people do. And you want to minimize taxes, and you want to protect your assets. You want to plan for retirement and have an estate to leave to generations. That's what the craft money map plan is. If you're a business owner and you really want to utilize your business to grow your wealth, or if you have real estate and you want to use real estate and figure out how to grow the wealth, that's where we help with. I myself am a real estate investor, as well as I mentioned the different businesses I have. So I definitely believe those are tools to create generational wealth. The IRS allows additional deductions, more than you could get as a W-2, for business owners and investors. The reason is they know that those entities allow additional revenue. They employ people. They do pay, some taxes. And that's why it's important to start investing in real estate or have a business, because as a W-2 worker, you're very limited on what you can deduct and what you can take as a deduction from your W-2 wages. Also, in the Craft Money Map plan, we talked about how you can legally utilize what you can do to reduce your tax burden. So what is the best entity structure? We talk about, should you do a LLC? As I mentioned earlier, the LLC structure, you could be a sole prop, a partnership, a C Corp, or S Corp. Do you know what structure is best for you? Also, how to protect your assets. So we work with asset attorneys, and they do asset protection for you. They'll tell you what type of structure is best for your entity structure. Also, you may want some estate planning, so that when you do pass, that you're leaving your estate to your loved ones and you're not subject to what probate court would say. If you don't have an estate, then the courts can tell you how your money will be divided among people, and it may not be what you want. So make sure at certain levels of asset ownership, you have an estate plan as well. So we talk about all of that in the tax planning. We equip you with a plan and educate you on how to reduce your tax liabilities and protect your assets and wealth. And we research, many businesses and documented strategies that are legal and ethical. So doing this plan, it's usually about 30 to 40 pages of research that we're going to have for you. We're just going to list the strategy, tell you how to implement them, and then we're also going to give you the code, so you know that this is ethical and legal, and it's a strategy that has been utilized and approved by the IRS. So the 5-step roadmap process, we discover and evaluate. Where do you want to go and where are you now? We need to find out where you are now. So we'll start with the entity map, just to outlay really where you are. Where are your entities and structures? How much do you have? Like, do you know your net worth? That's an exercise that we do in the Wealth Intelligence course, really knowing your net worth, which is your assets less your liabilities, going to show your net worth. Then we're going to determine, well, where do you want to go? If you know you want to buy real estate, what do you need to get there? What type of down payment do you need? What percentages will you do fix and flips? Many of my clients are in real estate, and we work with everyone from Airbnb owners to single family rentals, to fix and flips, to wholesaling, to buying notes, to 100-unit apartment owners, to construction. So we work with a lot of different real estate professionals, and I myself am a real estate individual that likes to invest. So we really will focus on, if you're interested in real estate, we'll help you get there. Which direction will we use to get there? That's where we talk about the strategy. We'll talk about the tax strategies or the real estate strategies or the business strategies, looking at your profitability, looking at your deductions that you can take, also looking at your projections for budgets. Then we'll execute. So there's a part that if you want any of these executed, we'll help you get there. And then we'll review, did you arrive at your destination? And if not, we'll calibrate, or you may change your direction along the way. So that's the 5-step roadmap. Another topic that I'd like to talk about is hiring your children and hiring your family members. So making sure that you're hiring your children properly. If your children are a certain age, and I usually will start hiring children usually at 10 years old, because there are different activities that your child could do at 10 years old. I know that many children are very good at internet and computers, so maybe they're checking your social media, checking your chats, sending messages. If you have some program responses, making sure that the children are set up in order to utilize your tools. Some of the other things that I had children do is Airbnb. If you're owner of Airbnb, cleaning up, maybe taking off sheets, putting clothes in the washing machine, picking up trash, taking out trash. Also, if you have a home office, that's an area that your children can help with, is taking out trash, opening mail. So what we want to do is make sure if you're hiring your children that you're keeping track of their hours and making sure that they have a job description. So you have a job description for them and you're keeping track of their hours to make sure that they are appropriately keeping track of everything so you could take them as a deduction. You would put them on salary. Now, if you are a sole prop single member LLC and your child is under a certain age, under 18, then the good thing is you don't have to pay the federal Medicare and Social Security for them. But if you are an S Corp or C Corp, if you pay your child, then you would pay them like you would any other employee, and they would have taxes taken out. The good thing about that is most of the time, if you're paying them under a certain wage, they'll get the federal taxes that they paid back. So I think it's 13,620 this year. It's around that amount, which is the itemized standard deduction amount. It's a standard deduction amount. If you pay them under that amount, then any taxes they paid for federal income tax, they would get a return on that if they don't have any other income that totals that number for the standard deduction. So hiring your children can be very impactful. It also teaches them how to manage their money. So you would just make sure that they get the money into their own bank account. You can then have an opportunity to teach them how to budget. You can use that money and they can use it for their activities. If they're in different sporting activities, they can also use it for school. So if you have them in a private school, you could pay them and then they use that money to pay for their private school. So that is a way to utilize hiring your children. Also, if you have other dependents and family members that you support, hire them as a consultant to help in your business. If they have the skills to do anything in your business, you can hire them to work in your business. A good thing about hiring your family members and your children is that when you do business travel, now they're employees and they may have a reason to travel with you on business. When we talk about business travel, one tip that I like to work with and really encourage clients to realize is that when you travel on business, you need to work 4 hours. It's supposed to be 4 hours to call this a business trip. Now, 4 hours could include the travel time to get there. That's included in the 4 hours. So if you travel, take 3 hours to get there, you have a 1 hour meeting, then the rest of the day is also deductible. If you do that on a Friday, a Saturday and Sunday stay over is non-business day. So you could also deduct the hotel for those days and of course the flight if you had the flight for those days. Then you have a meeting again. You spend 1 hour in a meeting on Monday and then it takes you 3 hours travel time. You get to deduct that Friday through that Monday, the whole airfare, all of the hotel. The meals, though, would only be deducted on the days you're doing business. And your transportation, ground transportation, is only on the days that you're doing business. But that's a great way to turn a travel trip into a business trip. And if your spouse is in your business, they go with you, their deduction for their air. And if your children are in your business, they're employees, you're deducting their air as well for the travel time. So that's a great way to utilize your travel. The 529 is a great way to utilize funds to set up for your children for their education. One thing you need to realize is on the 529, it can transfer, but you need to make sure that it's education, because if it's not education, you will not be able to utilize those funds. So I do like the 529 plan as a way to save for education for your children. But there could be other ways as well. So we can look at, if you're hiring your children, you could set up an IRA for your children. Or if you have some type of 401k in your company, your children can participate in the 401k. That way they can have retirement there as well. And it's a deduction for you. The 529 would not be a deduction, but it grows. And when you pull it out, it could be beneficial. But you could maybe have the same type of scenario, but you get a deduction if you set up a 401k or an IRA for your child through your business. Then your business gets a deduction for funding. And then if we do a Roth, it will grow tax-free for the child as well. So it's a deduction in the business, but you can do a safe harbor in there, a 401k safe harbor, which is a type of plan. You can do a profit sharing for your business, and those could be a deduction for your business. So when you look at the 529 plan, make sure if you have a business, look at those other options as well, as should you set up a 401k or some type of profit sharing in your business where it's a deduction and then your child could benefit as well.